Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. And today we're diving into some fresh deals from Live Nation Entertainment, Inc. They've been busy. Get ready to hear about a massive money move and how it is reshaping their finances. Before we jump in, if you like getting these straight takes on company filings without the corporate jargon, make sure you hit that subscribe button. And hey, we've got a lively Discord community where we break down these filings even further, so check the link in the description below. So what is the big news? Live Nation, the company behind so many of your favorite concerts and festivals, just dropped a report telling us about a huge new financial transaction. They launched a big offering of convertible senior notes, which is basically a fancy way of saying they retaking on a lot of debt, but with a twist. This debt can be turned into stock later on. They announced this on the 8th of October 2025. This report is all about a massive deal that officially closed on the 10th of October 2025. Live Nation successfully sold $1.3 billion worth of these convertible notes. That is a serious chunk of change. These notes are set to mature in 2031 and come with an interest rate of 2.875%. This means Live Nation is borrowing a lot of money, but they V-structured it so they might not have to pay it all back in cash. And get this, they even gave the people who bought these notes the option to buy an additional $100 million worth. So if demand is high, they could end up raising even more money. This shows they likely believe they can handle more debt or see a great use for these funds. So what's all this money for? Live Nation isn't just stashing it away. A big chunk of it is going towards paying off older, more expensive debt they recalling back or redeeming. All of their 5.625% senior notes that were due in 2026, those notes were costing them more in interest. They were also using this cash to pay off other existing loans like their Term Loan B and revolving credit facilities. Think of it as refinancing their debts to get better interest rates and manage their cash flow more efficiently. Some of the money is also earmarked for general business needs, which could include building new venues or buying back some of their own stock. This move signals a strategic effort to lower their overall borrowing costs and strengthen their financial flexibility. Now, about these new notes, they have some interesting features. Live Nation can choose to buy them back or redeem them. Starting around October 2028, this gives them a way to get out of this debt early if it makes financial sense for them. And here is that convertible magic. These notes can be turned into Live Nation as common stock right now. For every $1,000 of these notes, you could get about 4.459 shares of Live Nation stock. This is like saying the initial price for buying stock through these notes is around $224.93 per S-hair. If the stock price goes up significantly, people holding these notes might choose to convert them into stock, which could mean more shares floating around out there and a potential dilution for existing shareholders, if not managed well. However, there are also protections for the note holders. If something big happens, like a major business combination or if the company's stock is delisted, these note holders can demand their money back. This is a common feature designed to protect investors in convertible debt. As part of this whole debt reshuffling, Live Nation also announced on the 9th of October that they were going to fully redeem those older, more expensive 2026 notes. This redemption is set to happen on the 8th of November. This again points to their strategy of swapping out high interest debt for lower interest obligations. And the financial plays don't stop there. Live Nation also plans to shake up their existing credit facilities. They are looking to get a new Term Loan B facility worth $1.3 billion, a delayed draw term loan, a facility for $700 million, a multi-currency revolving credit facility for $1.3 billion, and a venue expansion revolving credit facility for $400 million. This is a massive refinancing and expansion of their credit lines, indicating they are preparing for significant operations and possibly further growth, with a specific eye on funding new venues. Oh, and a quick note on how this all went down. These notes were initially sold to select buyers, not the general public. These buyers, who they call qualified institutional buyers, are large financial institutions. They then resold these notes to other similar big players. This is a pretty standard way for companies to raise large sums of money quickly without going through the whole public offering process. Now, let's put on our investor hats and look at what this all means. Live Nation is making a bold move to lower its borrowing costs and get more breathing room financially. By exchanging their higher interest debt for this new, lower interest convertible debt, they're essentially saying they believe they can manage their finances better by paying less interest overall. The fact that they're planning to expand their credit facilities, especially with a dedicated venue expansion revolving credit facility, shows they are optimistic about their future and plan to invest in growing their physical footprint. The convertible nature of these notes is a key element here. If Live Nation's stock price performs well, they might not have to pay back all this debt in cash, which is a win, but it also means there is a potential for more shares to enter the market, which could dilute existing shareholders if the company doesn't grow its earnings at a comparable pace. It is a bit of a gamble, but a calculated one, leaning on their belief in future stock price appreciation. A significant risk here is the overall economic climate. If ticket sales or venue attendance falters due to economic downturns, their ability to service this new debt and the increased capacity could be challenged. Also, the interest rate environment is always a factor. If rates rise unexpectedly, the cost of their new debt could become less favorable. However, their focus on expanding venues suggests they feel confident that demand for live entertainment will remain strong. In conclusion, Live Nation is actively deleveraging its balance sheet by refinancing expensive debt with cheaper options and setting themselves up for potential future investments, particularly in venues. They're playing a smart financial game, but like any big bet, it comes with its own set of risks that investors will want to keep a close eye on. Alright, that is our deep dive into Live Nation's latest financial maneuvers. What's your take on this massive debt offering and their expansion plans? Do you think it's a smart move or a risky bet? Let us know in the comments below. If you found this breakdown insightful, please give this video a thumbs up and subscribe for more decoded corporate insights. And don't forget to join our growing Discord community, linked in the description. Thanks for watching, and we'll see you in the next Decode.